Hello, today in less than 5 minutes, KNG International Advisors will bring you up to speed on the international financial markets. This week's report is entitled, The Forward-Looking Calculus, Why Markets Price Tomorrow, Not Yesterday. Markets delivered another week of mixed signals as investors passed through a deluge of consequential developments, earnings reports from technology's most influential companies, the Federal Reserve's latest interest rate decision, and a breakthrough in US-China trade tensions. Yet beneath these headline events lies a more fundamental question about how investors should value companies in an environment where artificial intelligence spending soars, monetary policy remains uncertain, and geopolitical risks persist. The answer requires understanding a deceptively simple concept: markets care far less about where a company has been than where it's going. The price-to-earnings ratio remains the most widely referenced valuation metric in equity analysis, yet it's frequently misunderstood. At its core, the P/E ratio expresses how many dollars investors will pay for each dollar of current earnings. A company trading at 25 times earnings costs $25 for every $1 of profit it generates annually. This sounds straightforward until you recognize what the market actually prices, not current earnings, but expectations about future earnings growth, competitive positioning, and the sustainability of business models. A company trading at what appears an elevated P/E multiple may prove reasonably valued if its earnings compound at superior rates, while a seemingly cheap stock may deserve its discount if profits face structural headwinds. This forward-looking orientation explains why Meta tanked more than 11% on concerns about its AI spending despite reporting strong quarterly results, while Alphabet shares rose following the search engine giant's quarterly results. The divergence had little to do with past performance and everything to do with investor confidence in each company's ability to convert massive AI infrastructure investments into sustainable profit growth. Meta's disclosure that capital expenditures dollar growth will be notably larger in 2026 than 2025 spooked investors who questioned whether returns would justify the escalating costs. Markets don't punish investment per se, they punish investment whose payoff timeline or magnitude remains unclear. The technology sector's reporting week illustrated this dynamic with particular clarity. Mag 7 earnings were expected to increase plus 11.9% in 2025 Q3 from the same period last year on plus 15.3% higher revenues, representing steady but unspectacular growth for companies whose valuations embed assumptions of technological dominance. The results themselves proved less important than management commentary about AI monetization, cloud computing growth rates, and capital allocation priorities, the forward-looking elements that determine whether current valuations prove prescient or excessive. Tesla's revenue increased 12% to $28.1 billion, marking a return to growth after consecutive quarterly declines, yet earnings missed estimates as capital expenditures jumped. The mixed results underscore how markets evaluate not just today's numbers but tomorrow's trajectory, particularly for companies whose valuations reflect aspirations about autonomous vehicles and robotics rather than current automotive production. The Federal Reserve's decision this week added another layer of complexity to valuation calculus. The central bank lowered its benchmark overnight borrowing rate to a range of 3.75% to 4%, marking the second consecutive reduction. Yet markets reacted more to what came after the decision than the cut itself. Chair Jerome Powell stressed that a December rate cut is not a foregone conclusion, far from it, introducing uncertainty that had been absent from investor expectations. Lower interest rates theoretically support higher equity valuations by reducing the discount rate applied to future cash flows, but only if rate cuts stem from confidence rather than crisis. Powell's hesitation suggests the Fed sees a more ambiguous economic picture than markets had priced. The intersection of trade policy and corporate earnings became impossible to ignore as President Trump and Chinese leader Xi Jinping reached agreements that could reshape competitive dynamics. Tariffs on Chinese exports will be substantially lowered, while China agreed to pause for 1 year the sweeping export controls on rare earths that had threatened technology supply chains. For investors attempting to value multinational corporations, these developments matter profoundly. Companies with significant China exposure or dependence on rare earth minerals saw their forward earnings potential shift materially based on policy decisions rather than operational execution. The challenge facing investors today mirrors challenges that have always existed, distinguishing between companies whose current valuations reflect rational expectations about future performance versus those priced for perfection with limited margin for disappointment. A P/E ratio offers a snapshot, but meaningful analysis requires understanding whether earnings growth will accelerate or decelerate, whether competitive advantages remain durable, and whether management allocates capital effectively. The technology companies dominating market indices trade at valuations that appear elevated by historical standards yet may prove reasonable if artificial intelligence creates the productivity gains and new revenue streams that executives promise. This week's developments, from mixed big tech earnings to Fed uncertainty to trade policy shifts, reminded investors that valuation represents a continuous negotiation between current reality and future possibility. Markets will always price what they believe comes next, rewarding companies that deliver on forward-looking promises and punishing those that disappoint expectations regardless of past achievements. Understanding this forward orientation doesn't guarantee investment success, but misunderstanding it virtually guarantees misreading market signals when they matter most.